Hello friends, welcome to Sundar Mutual Fund's monthly debt market update. The month of June, like previous 2 months, saw a lot of volatility into the bond markets and rise in the yields. The month started the sharp rise in the bond yield across the curve on account of higher crude oil prices and rising bond yields in the global market. However, as we approached the second half, the global bond yield as well as the crude oil prices started to fall on account of concern of recession. This resulted into some correction to the domestic bond yields as well. And after some correction, the bond yields closed higher by anywhere between 5 basis point to 25 basis point across the curve, with shorter end rising the most. In terms of other major events during the month, we had RBI monetary policy at the start of the month, where RBI delivered a rate hike of 50 basis point with upward revision in its inflation forecast to 6.7% from 5.7% predicted in the previous policy, while keeping the growth projection same at 7.2%. This means that RBI is now looking to withdraw more liquidity from the banking system and raise the repo rate to fight against the inflation. In a similar action in global markets, US Federal Reserve also raised the policy rate by 75 basis points and also gave that they are ready to take further action to fight against the inflation. The Fed chair also said in the press con that the next policy, which would be happening at the end of the July, is all about deciding between 75 and 50 basis points. If we look at the Fed projection chart, it also shows that now the board member expect the Fed fund rate to reach 3.4% by this year end compared to 1.9% projected in the March. So this shows the central bank's intent to fight against the inflation. This is despite the market expectations that this sharp rate rise can lead the economy into recession. However, the various comment in the policy as well as the post policy have revealed that the central banks are willing to forego some growth to fight against the inflation. Similarly, Bank of England also continue this rate rise and they raise the rate by 25 basis points. This is the fifth rate hike since December. So it seems like that the globally central banks are willing to forego some growth to fight against the inflation. However, this rise has resulted into sharp rise in the dollar value against the other currencies, and particularly the emerging market currencies, more so the economies which are large importers of commodities, particularly the energy prices, as we have seen that countries like India, which largely hugely depend on import of commodities like energies, crude oil prices, the palm oil, and so many other commodities. INR in the last 3 months has depreciated close to 5%, and 2 months in the last one itself. What adds to this pressure is that on the one hand, the dollar liquidity is reducing in the market, which makes the dollar appreciate against most of the currency. At the same time, the high trade deficit. For last 7 months, the average is $21 billion monthly trade deficit, which used to be somewhere around 12 to 14 in the last year, which is a huge jump. This is not only contributed by the higher crude oil prices, but also by the non-oil and non-gold imports, which is a sign of upsurge in the economy. So this is one more factor added to the list of the factors which we would be watching closely in terms of future rate path. So as we look at now, what all the factors which would be impacting in the interest rates in the coming months. First and foremost is of course the inflation, uh, which as per RBI's projection is about to reach somewhere around 5.7% by this financial year end. The market economics expectations are by and large in this vicinity of somewhere around 6%, which would mean uh, that as per the guidance from Deputy Governor Mr. Patra, he is expecting a repo rate to be slightly higher than the inflation expected 3 to 4 quarters ahead, which would mean the terminal repo rate we could see could be somewhere around 6%. This is what largely the market expectation, 6 to 6.5% of terminal repo rate, which is by and large discounted in the bond yields as well. However, given that there are too many moving factors in this equation, as I said, the higher trade deficit, which can lead to some depreciation in the currency, which will have two consequences. One is that we will be importing higher inflation. At the same time, the actions from RBI to quell any sharp depreciation in the currency would mean reduced market liquidity and higher rates. At the same time, the additional pressure comes from the higher fiscal deficit, which would mean more and more supply of bonds from the government to fill the fiscal deficit gap, which is adding to this pressure and is resulted into this sharp term premium which we see currently. In terms of future rate progression, we believe that interest rates are going to remain volatile with some bit of more flattening of this yield curve. We have already seen continued steepening of the curve in last 3-4 months. If you look at last 3 months, the short end yields have hardened by anywhere between 120 to 130 basis point, whereas the long end, that is 10-year and plus, has hardened by close to 35 to 40 basis points. So 100 basis, close to 90 to 100 basis point compression in the long and the short end yields, which we believe can continue some bit more. So how investors should be looking to deploy their monies? So as I said, interest rates have risen pretty sharply in the short end, which makes the short end more attractive compared to what it was a few months back. However, still the curve is pretty steep, and as we move on to the higher duration, we get rewarded by a higher carry. However, to realize that carry, one needs to stay invested for that tenure. So the wise idea is that investors should be looking for the funds where the duration matches with their investment horizon. This would give them the best possible carry, and at the same time keep the volatility minimum for their investment horizon. Accordingly, investors looking to invest up to 1 month can look for cash management products like overnight and liquid fund, whereas investors looking for 1 to 3 months can look for products like ultra short duration and low duration, whereas investors looking to invest for anywhere between 1 year to 2 year can look for products like short duration, banking and PSU debt, and corporate bond fund, whereas investors looking for an investment horizon of 3 year or more can look for target maturity products or medium term bond fund. Thanks. With this, we'll wrap this session. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.